I'm Martin King. I'm property analyst here at Edison Investment Research, and I'm joined this morning by Stephen Inglis, who comes from ESR, which is the external investment advisor to Regional REIT. Stephen has a leading role in the management of the company and represents ESR on the board. Stephen, welcome back.
Hi, Martin.
Yeah, the year-end results were announced in March and were in line with expectations. So I'm thinking now is a good time to look at the strategic plan for the business moving forward, as well as the outlook for the regional office sector. And maybe we can start with that outlook for the sector, where there are signs that the strong headwinds of the past few years may be receding. A key concern during that period, of course, has been that since the pandemic, what the impact on the long-term use of offices will be. Are you now getting some visibility on this?
Yeah, I think we have been for some time. I mean, we're now seeing trends. Before it was probably a bit early to state trends, but I was on record very soon after the return to the office post-pandemic of saying I expected the majority of people to be back the majority of time. I think that's beginning to be borne out. It has taken longer than I anticipated, that's for sure, but it's beginning to be borne out by the vast majority of data that is now coming through. So Regional REIT, as you know, publish an annual update in terms of occupancy levels by staff in our buildings. The last one was published in February, and I'll be updated again at the half year. But that showed quite clearly that staff numbers were back to post-pandemic occupancy levels. And most interesting for us as an office landlord, one, obviously, is the number of people back in. And the second part is how many days they are back in. And on average, the last 2 years has shown that the average occupancy of our buildings is 4 days a week. I think that's very interesting data. We, of course, are in the regions, and that's a study of over 100 buildings in our portfolio, in excess of 26,000 staff members surveyed. So by far and away the largest survey of its kind. But that is slightly at odds to what's happening in London. London still is a little bit slower in terms of return, although again, the anecdotal evidence and those published data points are showing improvements. So undoubtedly there's a return to the office, and undoubtedly that is continuing and trending upwards.
Against that background, Stephen, can you talk about the trends that you're seeing in occupier demand, market supply, and what this means for office rents and office values?
Yeah, again, Martin, I will talk about the regional markets, which is our expertise, Regional REIT obviously being in the regions. But in the regional markets, we are definitely seeing, as we are across the country, a flight to quality. And that doesn't mean ivory towers of glass and steel and BREEAM outstanding and the like. It is high quality grade A space, and that's what we provide. And more importantly, and it has been a growing trend, are the ESG credentials and specifically EPCs. EPC A and B, of course, likely to become a statutory requirement by 2030. The entire world has been focused on that in terms of the real estate office sector. And that is clearly impacting on what tenants require and what tenants want. So definitely a flight to quality. We have seen a slight change even in the course of the last couple of years where traditionally people would take expansion space. That changed after COVID and people looking at it saying, well, we're not expecting the same numbers back in the office. A lot of companies downsized at that stage and they took higher quality space but less space. We're seeing that trend reverse, where companies now realize that if they have all of their staff in the office at a point in time, and the majority of companies are going that way, then they don't have enough desk space. So actually we're seeing an expansion from many of the original downsizers, particularly accountancy firms and banks. All of that, again, good from the supply-demand dynamics for the regional markets. So the trend is definitely for better quality space, grade A accommodation, and EPC A or B, i.e. to conform with statutory requirements going forward. Now, that brings with it a real challenge for the regional markets because the regional markets are approximately 82% occupied. so 18% remain vacant at this point in time. The majority of that 18% not fit for purpose, requiring extensive refurbishment to bring it back into modern use, or indeed is just going to be repurposed or demolished to make way for other uses. But at the same time, so 83% occupied suggests there's capacity in the market, but only 25% of the market conforms to EPC A or B. And this is a crucial aspect. If the majority of occupiers, and that's what we've seen trending in the last couple of years, want EPC A or B and grade A accommodation, how can we provide that when only 25% of the market conforms? And the growth in that, I mean, we've known about this issue for a number of years, and we, like every other landlord, have been frantically refurbishing space and ensuring that our space is fit for purpose. In Regional REIT's case, we're currently 60% EPC A or B, so we're quite a way along the journey, but we've still got some way to go. But that means we've got a supply-demand imbalance coming down the track at some point. If 82% of the market's chasing a market of only 25% conforming buildings, that would suggest there's going to be competition for those high-quality buildings, and that would suggest higher rental growth. Now, we've already seen a bit of rental growth, so this is a self-fulfilling prophecy. So, on average, for the last 2 calendar years, Regional REIT has achieved on the lettings we have done, and it has been a subdued letting market, but the lettings we have done, we've seen rents of 13.5% ahead of ERV. And it's not just us, we've seen that across the market for those better quality spaces. So rental growth has already started. I think that will be exacerbated by this issue that we have coming down the track. And I think rental growth, therefore, in regional markets will be stronger in the next 5 years than we've seen in the last couple of years. And I think, again, that's extremely good from an office landlord point of view. The second point, of course, is, in supply demand. What about supply? The demand is there for that higher quality space, which we think it is. What about supply? Well, we've only seen that 25% grow by 8% per annum for the last couple of years. Now, 8% on 25% doesn't even make a dent in that issue of 82% occupancy. If also we see many of that 18% vacant space being repurposed or demolished, then of course supply diminishes. Again, that's a trend we've seen for some time. Total stock and total supply has been diminishing as many buildings have been repurposed, roughly 22 million square feet last year in the regional markets. And that's a decent proportion of the regional market. When on the other side, new supply, we're seeing little or no new development. In all of the major cities, we're expecting to see close to zero developments come online over the course of 25, 26, 27. So, we do have a situation that will show a lack of supply and continuing demand.
So, Stephen, that all sounds very positive for the occupier market. Can you talk about the investment market and also what the outlook for valuations across the sector might be?
Sure. I mean, we have seen, obviously, a very subdued investment market. There's been little investment in the office market generally across the country for quite some time post-COVID. And that's really as a consequence of that risk element of not knowing where offices would end up post the lockdowns and working from home scenarios. I think we are definitely seeing more activity in the investment markets. We have seen a few deals happening. They're few and far between, but there are a few deals happening of what we would call core stock. But that is yet to translate through to improved values. So, I mean, traditionally, what you'd expect is more interest will stabilize the valuation market, and then as we continue to see that improving occupational story, that will give confidence to investors to invest in more office stock, and that will then show improvements in value at that stage. So I think in the short term, we expect to see a stabilization of values, and in the longer term, i.e., end of 26 and beyond, as that story and growth story on the occupational side continues, and gives confidence to the investor market, we expect to see values improving on the back of that. So I think, again, positive, but it'll take some time to come through.
Both those factors, the occupier market and the investment market, seem to be having a positive impact on forecasting for sector returns. Can you just say what you're seeing on that?
Yeah, I think most of the major commentators are now forecasting that offices will outperform the other sectors over a 5-year period. Of course, off a very low base, it's been the hardest hit sector in terms of values. Therefore, one would anticipate if we're going to see an improvement in the office market, which, given my comments on the occupier market and investment market, would suggest we are, then clearly from a low base, you'd expect to see offices perform very well. In terms of specifics, CBRE, obviously the largest commentator in the world and agent, are suggesting that UK offices will perform at 13% per annum over the next 5 years. And that's outperforming all of the other sectors by quite some way over that period. Now, these are predictions and forecasts that I think have to be treated that way. But nonetheless, I think that positivity, and it is the first time offices have shown themselves ahead of the other sectors, that positivity can only help the sector.
Stephen, can we now switch over to Regional REIT itself and how you have aligned strategy to suit these market conditions?
Sure. Obviously, we undertook our capital raise last year, which has been well commented on. You and I have discussed that previously. That supported the business in terms of reducing debt, which remains a key strategy for Regional REIT. Current debt in the early 40s, that will come down as part of our sales program. We are continuing to sell non-core assets. That's roughly 5% of the portfolio, and that sales program continues. And we are continuing, obviously, to look at alternative use for properties. I think that's probably a slight pivot from the previous iteration of Regional REIT. That is about 15% of the portfolio where we have identified higher value alternative uses for those assets, and where we are in the process of obtaining planning and positioning those assets to achieve full value when sold. And of course, concentrating on the 80% of the portfolio, which is our core and our assets requiring refurbishment to become the core. So that's really the strands of the business. So the core element being 80%, including the capex to core element, 20% being sales, of which 15% being value add sales. And all of that is well underway. However, as always in real estate, there'll be a lag before we see the benefits of that in terms of improved income from our core portfolio and improved capital upside from those assets that we will eventually sell with improved planning positions and repositioned.
The share price doesn't seem to be reflecting the strategic potential for Regional REIT or the improved sector outlook, Stephen. You've said there will be some lags in the benefits coming through, but can you say a bit more about what you're expecting in the near term in terms of earnings and dividends?
Yeah, the share price, you're right. The whole of the REIT sector continues to be depressed and has been depressed for some time. Our share price has been moving in line with the markets. As the markets go up, our share price goes up and vice versa. A lot of that created by geopolitical turmoil and little we can do about that. We very much focus on the day job and what is within our control. What I can say is we're targeting 2.5 pence per share quarterly dividends, so 10 pence in the year. And we're back to our old adage of we will make 4 equal installments if there is the ability to increase the fourth of the dividend levels, we shall. And we'll know that obviously as we go through the year. But at 10 pence, that's almost a double-digit return in terms of dividend return on current share price. Current share price has been bouncing around. We've been as low as £1 and as high as £1.20 in the last couple of weeks, quite literally. But no, you're absolutely right. None of the improvements in terms of the occupational market, what we expect to see in terms of the investment market flowing through in the relative short term, 12 to 18 months, nor indeed the value add assets where there are some considerable upsides. None of that is reflected in the current share price. And indeed, in the latter part, the value add elements, not even reflected in any shape or form in the NAV. So, the values are still traditional in terms of red book valuations. So they're on their existing uses as office buildings, not on alternative uses, which in many instances are substantially higher value. So yes, I look at the share price and the company as it stands. We've rebalanced the books in terms of the balance sheet. We're repaying debt, and debt is down substantially. We see decent pathways to growth in terms of gross rents and net rents, which in turn will reflect higher values. And also with this latest pivot in terms of the value add assets, none of which is reflected in the share price. So at the moment, we are where we are. I think the company is well set up to show substantial improvements on all fronts, and one would anticipate that will be reflected in the share price in due course.
Stephen, thank you very much for all of that. It sounds very interesting and a very interesting time to be looking again at the regional property sector. So we look forward to catching up with you later in the year.
Great. Thanks very much, Martin.